If you run a business clearing between $60,000 and $300,000 in profit, and you're still filing as a default LLC, you're likely overpaying the IRS by thousands of dollars every year. Most people confuse their legal structure with their tax status. An LLC protects your personal assets from business liabilities. But on the tax side, a single-member LLC is treated by default as a sole proprietorship, where every dollar of profit flows directly onto your personal tax return. This default status subjects all your profit to a 15.3% self-employment tax. This covers Medicare and Social Security, and it strikes every dollar you net right off the top. Electing S-Corp status does not require forming a new business entity. You keep your existing LLC and simply file paperwork asking the IRS to change your tax treatment. The mechanic is simple. You split your income into two distinct buckets. Bucket 1 is your W-2 salary, paying yourself as an employee. Bucket 2 contains your distributions, representing everything left over. The 15.3% payroll tax applies strictly to that W-2 salary bucket. Money moved into the distribution bucket bypasses that tax entirely. These savings aren't the result of a secret loophole. They are the direct result of a mathematical formula based on how much profit you can legitimately categorize as a distribution. We'll test this first with a freelance designer netting exactly $60,000 for the year, taking the standard deduction as a single filer. As a default LLC, her total federal tax bill comes to approximately $11,678. Almost $8,500 of that is purely self-employment tax. This table compares the two paths. On the S-Corp side, she sets a reasonable salary of $40,000, leaving roughly $16,940 as a distribution. Her federal tax drops to $10,520. However, running an S-Corp requires a payroll provider and a CPA to file a separate corporate return. This adds a baseline compliance cost of roughly $2,500 per year. When we factor in that overhead, the total cost of the S-Corp reaches $13,020. In this scenario, the election actually costs her $1,342 more than staying in LLC. Below $80,000 in profit, the inescapable costs of maintaining the S-Corp structure generally outweigh the FICA tax savings, making the default LLC the more efficient choice. The math shifts once you hit $100,000 in net profit. This is the critical transition zone. At this level, a default LLC loses over $14,000 purely to self-employment taxes. If the owner elects S-Corp status, a standard strategy would be a $60,000 salary and roughly $35,400 in distributions. Now we have to factor in the qualified business income, or QBI, deduction. Federal law has made this 20% deduction on business profit a permanent part of the tax code. This bar chart shows the hidden trade-off. For the LLC, the entire $100,000 counts toward the 20% deduction. But for an S-Corp, W-2 salary is specifically excluded. You only get the deduction on the distribution amount. When we subtract the $2,500 compliance fees and account for that smaller QBI deduction, the S-Corp total lands at $21,500, compared to $22,278 for the LLC. That's a net saving of $778. $100,000 in profit is the mathematical break-even point, where the tax savings finally justify the added complexity. Now let's look at a scaling business clearing $150,000 in net profit. Without an S-Corp election, the default LLC loses over $21,000 strictly to self-employment taxes, before income tax is even calculated. Using an S-Corp structure with a $75,000 salary leaves $75,000 in the distribution bucket. Looking at the side-by-side totals, the high volume of FICA savings on that large distribution now completely overwhelms the compliance fees and the lost QBI value. This structure produces a net gap of $6,500 per year. Over 5 years, that represents $32,500 in retained capital for the owner. At $150,000 in profit, the S-Corp structure provides enough consistent tax savings to fully justify the increased complexity and compliance costs. Again, you do not need to dissolve your LLC to make the switch. This is strictly a change in how the IRS views your entity. The process starts by filing IRS Form 2553 to officially request S-Corp tax treatment. The document must be filed by March 15th to apply to the current tax year, though late election relief is possible if you can show reasonable cause. Once active, you must run a formal quarterly payroll for your W-2 wages and have your CPA file a dedicated 1120S corporate return every spring. These administrative requirements are why that $2,500 compliance baseline is a fixed part of the mathematical decision. The most important variable in this equation, and the one that carries the most risk, is your W-2 salary. The IRS actively monitors S-Corp owners who set artificially low wages to avoid payroll taxes. It is a major audit trigger. Historical court cases show when owners take large distributions with zero salary, courts reclassify those funds as wages, leading to significant back taxes and penalties. A defensible salary for a service business should represent 40% to 60% of net profit, and it must align with what you would pay someone else to do your job. A salary that is too low invites an audit. A salary that is unnecessarily high destroys the very tax savings the S-Corp was designed to create. Summarizing, under $80,000 net profit, stay a default LLC. The overhead costs outweigh the savings. $80,000 to $100,000 is a gray zone. Have a CPA run your exact numbers. Once you clear $100,000, the S-Corp structure typically yields a measurable net positive. Keep in mind that individual factors like your state's tax laws, your health insurance costs, and your retirement contributions will shift your personal break-even point. Comment your current annual profit below, and I'll give you a mathematical read on which structure likely wins for you. Subscribe for our next breakdown on bonus depreciation. This framework is for educational use. Always consult a qualified CPA